Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to talk about a couple of things and how to become a successful investor. And I was looking through the YouTube comments. Someone was saying, it's all good until I disagree with like one little portion of something that I might say it might be real estate related or whatever. A good investor, it's not about being in a full agreement with me or any other person. What you're looking for is an angle on an approach or an angle or strategy that's different than everyone else. The way that you make money as an investor is basically taking the opposite stance as everyone else. So you need to identify what everyone else is thinking and then take the opposite stance. Because if everyone is thinking a certain way and all their money is in that idea, the opportunity isn't there. All that money flow is already in that asset. So you're going to have to take the opposite bet of that, of the bets that everyone else is taking. And it's very hard to do because everyone feels comfortable to be in um, they're comfortable being in the majority. They're just a bunch of, I'll call it zebra, where if you're in the herd, then no one can attack you because you're in with everyone else. If you stand alone and your thoughts are different than someone else's, then that's where you can be attacked. That's where basically everyone's going to come after you. And right now, the herd is thinking that we are going to have a recession, this big blowout crash recession, at least from YouTube. A lot of the channels think that we're going to have some big blowout crash. I don't think so. Yeah, we could have a slowdown. I don't think it'll be a big blowout crash. And the reason is I don't think we have the deleveraging in the real estate market. And if we do see slowness, which we do see slowness, that slowness has to continue until inventory levels get to a very high level. But obviously, I have a different stance on that topic, given the surge in stimulus money into the system and the interest rate following that stimulus surge. So I do think rates will come down. We'll go into a disinflationary period. That will be your weakness, not a crash. I don't think. You'll have a period of weakness, which we could have already gone through. We don't know yet. Or we're going to be getting close to the end of this weakness. And then something's going to happen where they may have to back off on the interest rates. And we'll see what happens. We'll see what happens. I've got data behind me too. Another thing about being a successful investor. So number one is taking an opposite approach of the herd. I did that in 2020. I bought uranium, oil, and natural gas. I bought all that stuff at the bottom, gold and silver, precious metals and precious metals companies. And there was a lot of people talking about oil never coming back. Never coming back. Kathy Wood was stating that oil would never get above like $35 a barrel or $30 a barrel again. It's completely done. And I looked at kind of her as just being completely crazy, but that worked out well. So basically, if you just do opposite of what she does, I think you could do pretty well. Same with Jim Cramer. I think Jim Cramer, we have a lot of people talking in the public that have this completely backwards. They either, I think on Jim's case, he's probably getting people to buy when his buddies are selling. That's my guess. Because his calls have been so bad, so consistently bad, that I think he probably knows what he's doing. It's not just at random. And Kathy she doesn't know what she's doing at all. She is oblivious to the business cycle, perhaps. But to be a very good investor, you have to take opposite of the herd. And then you have to know what to look at. You have to know the business cycle. You have to know what data to look at. And there's some data that just doesn't really give you much information. And then there's other data that I would consider to be leading indicator. And I've got some data behind me. I think that this is one of the leading indicators. And I did a whole write-up on the website for silver and platinum members. because this is more of a financial education piece. And I'm going to show you kind of what this data is here. So let's dive in. So this is total bank credit divided by gross domestic product. So the question is, why do we want to look at this? Why do we want to look at total bank credit divided by GDP? So we've got this consumer price index number, and the consumer price index number measures the prices of goods in the system. The prices of goods in the system is impacted by total bank credit divided by GDP. So what that means is it is the entire credit divided by your gross domestic product. So this is basically your dollars divided by the accompanying goods and services with it. Inflationary periods come when your credit goes up at a faster pace than your goods and services. And when that happens, you have more dollars or credit chasing fewer things. And that's where the imbalance comes. So if I were to test this theory and we were to look at this, we had a stable bank credit to GDP all the way up till where I've got this red line where it broke out, 1998. 1998 was the period where, if you were to look at our commodity to stock ratio, our commodities were dirt cheap and the ratio was off. So for whatever reason behind the scenes that this ratio was going up, it could have been derived by a few different options. Either your bank credit went up at a faster pace than your commodities, or you had a problem in commodities. Or it's a combination of both of those things. You had credit coming into the system at a faster pace than you can raise your GDP. And that's the imbalance. That's how that ratio goes higher. So we had a very big move in credit outpacing GDP during this time frame, which is inflationary. We also had the real estate market coming into an expansionary phase, pumping credit into the system. I think that's mainly what the cause was, not so much from the commodity side, which is your GDP, which impacts your GDP. That's the input to GDP. So if you were to look at this, your inputs to total bank credit is basically lending. That's what drives total bank credit. And if lending is what drives it, then your demographic size, the size of the demographic, the size of the population as it comes into home buying years, is a driver. Your GDP, the drivers of gross domestic product, is basically how efficient you can translate energy into products. If you have an energy constraint, it's going to blow up the GDP side. So think of it as Europe, Germany, and all these other places over in Europe and England, and all the problems they have with energy, their GDP is going to decline. And notice here that we also have another breakout. We had a consolidation period, and then we broke out in 2019 to the upside. That was that QE that they were doing, and some other stuff. And that broke to the upside, and obviously we've had a pullback here recently in 2021. And it takes time for this money to kind of work its way through the system, this ratio. And it looks like we're ready to kind of come back up and head higher again with total bank credit to GDP. Now, what I took is I took total bank credit, that's the top here that we just described, and the inflection points of breakouts. That's what the red lines are. And I posted below it the graphs of crude oil and the Baltic Dry Index. Crude oil and Baltic Dry Index are basically the most inflation-sensitive areas. Crude oil being the most inflation-sensitive and Baltic Dry Index being linked to crude oil. These two sectors are probably some of the best ways to play an inflationary move. So the main thing here is we broke out in 1998. We had a commodity to stock ratio that favored commodities. We should have been buying commodities in 98, 99. That was the beginning of the bull market. This total bank credit to GDP broke out in 1998. This, I think, is the leading indicator. The total bank credit to GDP. You could have taken positions right after the breakout here in crude oil at the bottom here at $11. You could have also got the bottom in the Baltic Dry Index. We can see this thing kind of move higher here. And you can see that the Baltic Dry Index, which is the blue line on the bottom here, is very similar to crude oil. And you can see that this basically mimics the exact way that total bank credit does. So what happens is total bank credit comes into the system. Just think of it as more money chasing fewer goods. And since crude oil is the #1 commodity in the world because it's used in all of the products like plastics and all this other stuff, it's also a form of energy. That inflation from bank credit is going to put all of the things in the world into a shortage. And the #1 commodity is really where it's going to get impacted the most. That's where you're going to have the most inflation sensitive pricing. And crude oil went on a gigantic bull run. That was from 1998 until it stopped going up in the year 2008. And then we had a deleveraging, and that deleveraging came from the real estate market. It was bad loans in the system. So total bank credit went down because of those bad loans. So that's the origin. That's the root of the problem, and that's where we want to be looking at. Now you can see crude oil has gone up a lot during that time frame. That would have been a great investment. So when bank credit outpaces GDP, the spot to be is crude oil and the Baltic Dry Index and other commodities that are inflation sensitive. And the next cycle is when this starts to come back down. That's when gold does very well. It's kind of 2006 onward. It's kind of the back half of that movement. But if you look at it we have now, if I kind of zoom in on the right-hand side here, we've got a breakout and then we have a consolidation. This broke out in November of 2019. That was a leading indicator. And if you notice, we kind of went down here in 2020. We bottomed, and that would have been our time to buy. And we should be holding crude oil and Baltic Dry Index. You can see that we're going through a consolidation period. That consolidation period. Oh, where's my guy? There we go. Consolidation period is this right here. That's the consolidation period. Trying to grab this and move it. And there's a consolidation period there, consolidation period here. We are consolidating. There's your 3 humps. This thing's ready to break and go higher. I think that we've got the breakout. And I think this will go higher for total bank credit in relationship to GDP. I don't know the necessary timing of it, but right now we're in a consolidation. I think it will roll higher. So if we come on back, I also did something with the Baltic Dry Index. Notice that we have these downtrend lines. We break the downtrend line, and then we basically have a pullback, kind of sideways motion. That is your bear trap, in my opinion. There's the bear trap. We are creating a bear trap. We are creating a bear trap. So we had our first surge higher. We pull on back, and then we rip it. So I think we're gaining a little bit of timing out of this on where we are in this cycle. So think of this as the first wave, the first wave, the first wave. That's the first wave. Then we go into consolidation. Then you get a second wave. So this is the consolidation. You get a second wave, and then your last wave. Or this is called the third wave, and then the fifth wave, and then we go into consolidation period. So right now, I think we're in the bear trap, which means that people are going to get bearish. They're going to say it's all done. Commodities are done. It's not coming back. They're all going to get squeezed. That is the bear trap. This here in this box here looks the same as this consolidation here in this box. They're basically the same thing. The 3 humps, consolidation pattern. Yeah, they look a little bit different, but that's where we're at, and we have a large move after. This is the 3rd wave, and then the last 5th, and then you're done going to large consolidation. It's a double top there. We still have the big move to come, guys. We're still early in this gigantic commodity big picture. So one of the leading indicators to look at is total bank credit versus GDP. That is an important data point to be looking at. Another one could be M2 supply divided by GDP, which is basically money velocity. Another thing to become a good investor, and what I'm doing with the website, is on the website, I find incredibly good patterns in very good sectors. I'm basically screening everything for everyone. And I'm taking entry points in these things that are very, very low. They're very early and kind of the laggards in some of these with good entry points. To be a good investor, you're going to have to manage your emotions. You're going to have to know the time frames. You're going to have to know that some of this stuff doesn't happen immediately. They may grind sideways. We're buying things that are stuck up against resistance. And they may grind for a while. They may grind for 6 months to a year. And then when they release from that resistance, you get the big, big move. The 500%, the 600%, the 10-bagger, the whatever it is. But you kind of have to like know that. You get some experience using it. And then you get your confidence up. That's all necessary in the progress of becoming a good investor. And what I'm doing is I'm hopefully accelerating that movement where your progress hopefully will progress at a rate that may be infinite, because you would have never progressed that way if you just hadn't have seen it. There's people on the website that are saying that they've completely changed their strategies because they've seen from beginning how I explain it, then they see it. And they can also see it in how I'm positioning and what I'm buying, and then they may follow it or they may buy and track it. And they're like, wow, that's how it's done. You buy something when it's really low based off of the ratio being cheap. You've got your leading indicators telling you kind of what's coming up. We can see through Elliott Wave and other technical analysis how the herd kind of moves. And then we get results. And it doesn't happen in weeks or months. It happens in years. And sometimes it can happen very quickly. Sometimes it can be in weeks and months, depending on where we're identifying the value. And some of these, they are mid-stage, so they already came off a base and they're consolidating in a mid pattern. Those are typically faster. They move up more. If you're trying to catch the bottom of the bottom, those take time. And we have various investments. I have various investments at different stages of where they are in their cycle. The exploration production companies are kind of more, they've come off that big base and they're stuck kind of in inverted head and shoulders. And they're scribing it out on the, we'll call it the right-hand shoulder. Some other ones are still at the bottom of a double bottom. Those are going to take some more time potentially. Others are putting in a double bottom and they're right at the top, which traders would consider to be the ideal entry point. We're using fractal analysis to determine what the potential moves are in the future, which is basically Fibonacci. Basically applying absolutely everything that we can from a technical analysis standpoint, from a ratio perspective, and from a market condition perspective, looking at the supply-demand market balances and deficits. So if that's something that you guys are interested in learning, obviously sign up, the Platinum membership, platinum-.com. Go there, use the word discount in the coupon code and get yourself a discount. I will show you what I think are good entry points, and you guys will have to determine what you want to do. But they're all there. The data is here. I'll show you all this data as it progresses. I'll find the good companies with the good fractals, good entry points based off technical analysis, and then you guys will become better and better. But it still is dependent on you. What I'm doing is I'm underhanding lobbing. I'm underhanding pitches that you can hit, but you still have to hit the ball. You still have to hold on. You still have to have emotional control. You still have to become a good or great investor to make money. It's still dependent on yourself. And what I'm doing is I'm basically trying to eliminate all the variables that I can, but it's still going to be dependent on the person. It's going to be a battle between you and yourself. And that's where the patience comes into play. I know some people made some comments, hey, you had some insanely good picks. I sold it because I became impatient. And now it's up 500-600%. So some people say, well, what I should have done is just held. And I'm like, yes, that's right. Patience. We're identifying these things when they basically before they jump and they're up against resistance. Patience is required. It's a battle between you and yourself. Being patient, knowing that you've got the good company, knowing that the deficits are out ahead of us, knowing that the leading indicators are still positive or maybe they're shifting negative and we just have to be more patient. Those are all things that we have to do, that you have to be if you want to be a great investor. But that's what I've got for today, guys. If you want to join the website, Platinum membership, finding-value.com. Looks like I lost my little guy there. I'd love to have you in the community. You can ask whatever questions. Doesn't matter how experienced or inexperienced you are. Doesn't matter. I can help you out. Give me a thumb up for the content. Subscribe to the channel if you haven't already. And we'll catch you next time. And Merry Christmas. Merry Christmas to everyone, or Happy Holidays, however you want to say it. Whatever you are celebrating, it's fine. All right, guys. I will catch you later. This is Finding Value.